Hi everyone, I'm Tom LeBlanc with Tom LeBlanc Finance and welcome to the channel. Here, we talk about saving money, making money, and investing money all on our way to financial freedom and financial success. So if this kind of thing interests you, please like and subscribe below. So in today's video, what I want to be talking about is how the stock market actually works. As we recall from my previous video, a share of a company's stock entitles you to a portion of the profits of that company and gives you partial ownership of that company. So if you own one share of that company, you own the company in proportion to the number of shares that are currently outstanding. This basically means that you and everyone else that owns shares all collectively own that company together, hence why it's called publicly owned. So for example, Warren Buffett owns 907 million shares of Apple at the moment. Apple currently has 16 billion shares outstanding. So this means that Warren Buffett actually owns something like 5% of Apple. Now again, he's not the CEO of the company or anything like that, but he is entitled to that percentage of the profits of the company, should he sell his shares. So with that out of the way, let's talk about how the stock market actually works. So starting at the very beginning, we have a company, let's call it Company A, is doing very well and is growing larger and larger in terms of volume. At some point it's growing at such a rapid pace, or it's just getting too big to keep growing with the capital that it has. So Company A in this instance might have to hire more people, lease more office space, provide more for research and innovation, and other costs such as this. So one way to raise capital to keep expanding is by issuing shares. This is known as equity financing. So this is where a company will issue what's called an IPO, or an initial public offering. Essentially, this is when the company goes public. An IPO essentially refers to the issuing of the stock of a company to the public. This is a huge step for any company, as now it provides the opportunity for that company to raise a lot of capital. Essentially, this gives the company an even greater ability to grow and expand. So the stock exchanges where these shares are bought and sold are what's called secondary markets. This means that the transactions of the stock itself are actually made simply between the buyers and the sellers of those shares. In other words, when you buy shares of stock of a company, you're not buying them from the company itself, but rather from another shareholder. And on the other side of things, when you sell your shares, you're not selling it back to the company, but you're selling it back to the market itself, and to another shareholder. Because of these exchanges, the stock prices can move a lot due to, you guessed it, supply and demand. If more people want it, the stock price will go up. If less people want it, the stock price will go down. This is because there will be more buyers when it's more desirable and less buyers when it's less desirable, and therefore more sellers too. Basically, if more people want to buy the shares of the stock than want to sell it, the stock price will go up. And if more people wanted to sell the shares than buy it, then the stock price would fall. So with that being said, the price of the shares of a stock of a company can move a lot based on how investors feel the company is worth. The company may be worth more or it may be worth less, but how to determine that gets a little more complicated. There are important ratios and metrics that you can use to make your own predictions, but I'll talk about that in the next video. Essentially what you're looking for when you buy a share of any company is a stock price that is undervalued, so that you can buy it at that lower value and then it'll increase. This is how people make a lot of money in the market. So in a nutshell, that's how the stock market works. If you enjoyed this video, please like and subscribe below for more videos like this one. And thanks, I'll see you in the next one.